Let's try this again. I don't typically do recording, and when I do, I try to do it all in one take, no mistakes. So if I get 15 minutes into this video and I start slipping up, don't blame me. All right. Now, let me go ahead and say this video is well worth your time, regardless of what the end point is. If it's 20 minutes, 30 minutes, please watch this in full if you're new to trading and intermediate to trading, or if you think that you're advanced. You can always fact check yourself. All right. I've been trading for the past 3.5 years. I've been doing so on crypto, but I've kept track of many other markets and saw strategies that work the same there. So, regardless if you're in the crypto realm or not, if you're using leverage, even if you're not, this video will be important to you. This is specifically primarily geared towards people using Bybit or leverage on crypto, all right, because that is a dangerous world to live in. I'm sure you've seen many YouTubers talking about don't use above this leverage, don't use that leverage. All that's bullshit. All right, this is what this video is about. Your leverage is a variable within the stew of constants that are risk management. Leverage is going to change on a day to day basis, a trade to trade basis, or if you have a direct strategy that calls for a certain level every single time, you're pretty much going to be using the same leverage all the time. All right, so this is what we're here to cover up. All right, so let's go ahead and get started with the nitty gritty. In order to even start this process of trying to figure out what are the mathematics of trading, all right, you need to have a trade strategy. Obviously, before you even have a trade strategy, please have trading psychology down. All right. But obviously, some people just, you know, throw shit at a wall and see what sticks. I'm kind of that person as well. So we'll see. Um, no matter what your strategy is, whether it's EMAs, SMAs, MACD crosses, market cipher, the way that you get to this strategy is not important. The simple fact of it is you're trying to find a couple different things to make sure that you are long-term successful in this market. One, it is win ratio. A common misconception in all markets in trading is you need to have a high win ratio in order to be effective in the market. Now, depending on what market that is, I would say that's pretty accurate. But here's the thing. I've been trading for the past 3.5 years, and I probably have, I would say, a 15 to 20% win ratio. Given that fact, you might think I'm pretty crap at trading, but we take a look at my portfolio, you can see the big difference. The reason why is because as we get further into this video, you're going to see that your win ratio, comparative to your risk to reward ratio, are very important factors if you're going to be long-term successful. So once you figure out what your strategy is, hopefully that strategy includes where will I enter? What price am I willing to get out of the trade if things go wrong? And where do I want to take profits, roughly? All right, it doesn't have to be exact precision. So, for example, I loaded up ETH here. Now, on a larger time scale, I'm identifying this level right here, 2,432, as the level that I would like to short. This now turns my chart into an if this then that statement, basically meaning that if I am below this line, I can stay short. If I go above that line to a certain degree, 1%, 2%, that is completely up to you, right? I want to get out of the trade, all right? Because one thing that we don't want to do as traders is hold on to losing trades, all right? So that's why if you have a strategy that can identify when trades are beyond a certain point of loss, it's time to get rid of it. So I'm going to go ahead and open up a trade as long as I'm below this line. And let's say that I use a 1.5% stop loss. This is on Ethereum. And let's say that I'm targeting this lower level right here of 2,149. And I'm going to take my profit a little bit before that level gets hit. You can see right here, using this tool in TradingView, over off to the side, long position, short position, we can calculate this number right here, 6.79. That is what's called a risk-reward ratio. Basically meaning if I'm willing to lose, all right, and this is very important, what you're willing to lose, all right, if I'm willing to lose $100 and I win this trade, I will make $679 back, all right? That's very, very important towards how we're going to play into the mathematics. So obviously the end goal is to find a strategy, and you want to find out what the win ratio is and what is the average takeaway when you do win trades. All right. Now, you have to figure this out for yourself. All right. It is person to person dependent. And as well as that, RNG plays a factor. There's randomization in the market. If someone says you have a 30% chance to win, that does not mean that every single time out of 100 trades you're going to win 30. Sometimes you might win 50. Sometimes you might win 10. But over the course of the last 2 years that person has been tracking that record, they might have an average of 30. That's what's important. All right. So now what we can do is we can find out what is the correct leverage to use on this trade, this particular trade that I'm looking at right now. All right. So in the description of this video, there is going to be a link to what's called Kite's Restored Calculator. All right. This is a very simple mathematical formula to figure out what is the correct leverage to use based on your risk parameters. Now, you can set this calculator up a plethora of different ways to get different leverages, but always willing to lose the same exact amount of money. I can have a 1.5% stop loss, and I can configure this calculator to use 20x leverage or 5x leverage. It is the same trade. I'm going to make the same exact amount of money, and I'm going to lose the same exact amount of money. If that doesn't compute yet, use the calculator for a little bit and kind of conceptualize it for yourself. You might be a hands-on person. So let's say that I have a $1,000 portfolio. All right. I'm going to go ahead and put in $1,000 here. Now, before I fill out these two sections right here, margin size and risk, I'm going to go down here to the stop loss and put in our stop loss. All right. So I have a 1.5% stop loss. All right. Now, what you are willing to lose and your stop loss are completely separate when you're using leverage. All right. So right here, the current way that I have it set up, you can see down here in the bottom left, portfolio at risk is at 0.24%. I would recommend that if you do not have a single clue in the world what your trading strategy, and especially for you in particular what that trading strategy has in terms of win ratio and average R&R, you sit in the lower echelon of risk. I know that might not seem exciting to you at first, but please, we will work through this. As you become more secure with the mathematics of your trading strategy, you can push this further towards the limits of high profit and still low risk. All right, but it's all in due time. All right. So let's say that I want to use 1% risk. You can set this up using 8% of my portfolio and using 15%. Nope, 13%. A little bit less, 12.8, 12.5. Yep. So 12.5% risk of said 8% is 1% of the whole. All right. So risk, what I'm willing to risk, what I'm willing to lose. If I get stopped out of this trade, I'm going to lose $10. $10 of 1,000 is 1%. My margin is 8%, $80. So I'm entering the trade using $80 of my money, and the exchange is covering 8x more than that. All right. This is why we use leverage. Leverage, if used correctly, is used for one purpose and one purpose only. It is to make sure that the price action that you are taking advantage of, proportionate to how big it is, you get the correct reward size, as well as that portfolio exposure. All right. You do not want to, if you only have $1,000, you do not want to keep $1,000 on Bybit. I personally trust Bybit. I've been using them for 3.5 years. I've never had a problem with them, but you don't know what's going to happen in the future. Do you want your entire portfolio on Bybit? I don't think so. All right. So if I want to use even less, I can use 4% of my portfolio as margin, and I can risk 25% of said 4%, which is still $10. So now you can see my leverage goes up, but my stop loss, everything else stays the same. I am still willing to lose $10. Therefore, with a 7 R&R, I am going to make $70. See how the leverage is not what's making us money? It's the other factors that play into leverage. Like I said, leverage allows you to keep less of your money on the exchange, but make just as much as if you had 25%, 50%, even 100%, depending on how risky you're being in the market. So that is how we calculate leverage. All right, now what we're going to do is we're going to put this into a conditional. Now, if you're using inverse perpetual, it's as simple as putting in the contract size down here in the bottom right. If you are using USDT, you just need to make sure that when you have 17x leverage selected and you are fat fingering in how much Ethereum to use, that your open short or open long equals 40 USDT. So let's go ahead and do that right now. All right, so let me go ahead. We are on Ethereum right now. We're going to go over here to set a conditional. Now, I'm using a conditional market order, all right, because I'm currently above this level and I want to enter as we pass, right? Otherwise, I would have to be setting up my computer all day waiting for this to kind of happen, which, I typically am, but for most people, not. All right, so I want to enter if we get down to $2,425. So we go over here to the trigger price, we type $2,425. Now, I go over here to short, and I click on that, and I set the leverage to 17x. Nope. 17x leverage. And now what I'm going to do is I'm just going to type in a random number. Let's say 5 Ethereum. All right. Oh, my 2,425. 2,425. All right. So you can see down here. I know it's probably not the best. Maybe I can zoom in for you guys. Don't worry about it. I got you. All right. So right here, you can see right underneath open short, our margin would be the equivalent of $731. We're trying to get it down to 40 bucks. All right, so 5 Ethereum is definitely way too much. Let's try 0.5. All right, 0.5 Ethereum is worth $73. So now we need less than 0.5. Let's do 0.25. All right, 0.25 is worth 36. So we do 0.27, 39, 0.28. $41. So we need 0.75. We can't do increments of that. So we either have to settle on $39 or $41. It's close enough. What's important is you're paying attention to get as close as possible to the exact amount that you want to lose. Because if you are kind of choosing what your leverage should be, how much of your portfolio you should use based off of how you feel in the market, you're not trading correctly, because that is not replicatable over a point of time. As well as that, if you are tracking your statistics properly, that's making it even harder to figure out what is the consistency of what you're doing here. All right. And then I would hit sell short with a TP/stop loss. All right. And here's the kicker. All right. I don't have to put in the exact number that I want my stop loss to be. All right. So that is $2,455.50. Because I am willing to risk 25% of my margin, all I have to do is go over here to stop loss and hit 25%. All right. That's going to make it, you can see right here, your expected loss will be $10.24. Expected loss, $10. All right. See how that matches up? And then we would hit open short. And let me zoom out and not be an old man here. All right, we would hit open short, hit confirm, and now it is sitting in our conditionals with a stop loss, and we can even set up a take profit. We were looking for what, 2,200? All right, and you can see if we win this trade, we will make $63. So $63 profit divided by $10 willing to lose is a 6.3 restored ratio trade. So why am I talking so much about R&R and statistics and all this stuff? So this is a very, very important of the trading important part of the trading process. But when it comes to being an expert trader, if you guys, anybody out there listening, wants this to become a full-time job, just know it's not going to happen fast. But you can accelerate that process through the use of crypto because crypto, if done correctly, has minimal risk and a lot of upside. I know that sounds like a sales pitch. I'm very sorry, but it's the truth of it. Um, so right here, this is the Kelly Criterion bet calculator. This will also be in the description. This one's not made by me or my team, but this is very, very important. So what this does is takes probability and how much are you going to make versus what you're willing to lose, and it gives you a, uh, an optimal percentage of your portfolio to bet. All right. As we get further, you will see what I am talking about. All right. So if I have a 20% chance to win a trade on average over the course of testing, all right. And every single time that I win a trade, the average risk reward ratio is an 8. All right. Now I'm using $1,000, but we're going to hit calculate. It says that out of $1,000, I can risk $100 per trade and be safe. All right. If I lived in a perfect world where I only won 20% of the time, all right, and I always won 8-to-1 odds, I could use $10. Okay. Dude, someone's honking outside my house. Go get them. Go get them, guys. All right. Now, we can even take this a step further and run a simulation. Hopefully, this will also be in the description of the video if you guys want to do this. If you guys have a $4,300 portfolio and we punch in these numbers, 8-to-1 odds using a 20% chance, all right? If we could risk 10% of our account per trade, within 50 trades, we would go from 4,000 to 11,000, and then to 15,000, and then to 2 million. All right. So why is everybody not doing this? Because here's the thing. This is if we're in a perfect world that every single time, without fail, every 100 trades, I won 20 and they always had 8-to-1 odds. I could use that number. But we do not live in a perfect world. You are fallible as a human, despite what you might think. All right. And we live in a market, especially the crypto market, where things are volatile and they change all the time. All right. Different strategies work better in certain types of markets. That's why if you have a strategy, it's important to test it all the time and find that average over the course of time, not just over the course of trades, because I'm going to be testing this strategy out during a sideways market, during a bear market, and during a bull market to see how it reacts on average across all three. Then and only then can I find out exactly what I should be betting in terms of percentage risk. So this is where you get introduced to something called adjusted Kelly. Kelly is a logarithmic curve basically telling you this is the optimal number to bet where you have the least chance of going bust, losing your entire portfolio, and the most amount of profit. And because we live in a volatile world of emotions and markets, we are going to use adjusted Kelly. Basically meaning if I have these statistics to back this up, even though that is the maximum I could use, we should probably be using, in the crypto market, I would say 1/10 of that. So what does that equal? 1% risk. So you can see how that 1% rule comes in handy sometimes. So that's what I was saying before. If you are using, based off what you know, the correct amount of risk, and halving that, or even 9/10ing that, if that's a phrase, then you're going to be okay. All right. Keep up the good work. All right. Make sure that any loss that you take, you can add back to the account eventually. All right. And proceed on. Because let's say that we have $1,000 and we have a 20% chance to win and 8-to-1 odds on average. And I'm only risking 1%. And let's say over the course of half a year, I enter 500 trades. All right, we added still with 1% to the portfolio, 15x, 1,400%. Let's run the simulation again. 23,000. Let's run the simulation again. 19,000. So, even with good risk, we are still making a substantial amount of money. Right now, we can even be using less. When chance, we can use 15%. And let's see what we walk away with. All right. With 5% less of a win rate, we only double the account within half the year. The next half, we double it again. All right. I just want you to have realistic expectations. So, obviously, the psychology of trading is very, very important. All right. Trading in the Zone by Mark Douglas is a really good place to start if you guys are looking into that. And then you want to move on to selecting a strategy. Find somebody that has a good strategy or make up your own. But what's next is ruthless amounts of testing. And if you can't get through that, you probably don't have a good chance of making this a career. All right. Because the people that are spending the time to test this and make sure they have it right are the ones that are going to last. And then once you have the statistics over the course of maybe 3 months, you can start to use a quarter Kelly, a 10th Kelly, and try to push it. Hopefully, this cleared up some misconceptions about how to do things correctly and how to do them incorrectly. You guys can always leave comments in the comment section asking any further questions that I missed. From what I know, I answered it pretty good. So you guys can always catch me in either my live streams or Ryan Matta's live streams. And we're always here to help you. So I appreciate you very much. Hopefully, you guys have good weekends, good weeks, and I appreciate your time. I don't do well. I don't do well with goodbyes. I'm very sorry. I'm very sorry. Goodbye. I love you. Be good humans.